quite a few things to learn regarding merchandising accounting, and the objectives are basically we're going to talk about how is merchandising different than a service company, and we'll talk about some of the unique transactions that merchandising companies go through. We'll talk about the differences in the financial statements. We'll talk about the adjusting and closing process. It's just a little bit different for a merchant. And then we'll talk a little bit about ratios. So first, let's just talk about the activities that distinguish a service company from a merchandising company. And so for a service business, you can see a very simplified income statement of fees earned minus expenses equals net income. But for a merchant, we have to also think of sales versus fees. But then we also have something called cost of merchandise sold, or sometimes it's called cost of goods sold. And that gives us gross profit, which is our markup, basically our sales price over the cost of inventory sold to customers, represents your gross profit. And then we deduct from the gross profit expenses for running our store to get down to net income. And so when merchandise is sold, the revenue is a sale, but the cost of the merchandise is an expense. Okay, and we then take our sale, subtract the cost of the goods sold, get our gross profit number, subtract expenses to get down to net income. So just a little bit more to the income statement for a merchant than there is for a service company. And that gross profit is basically what our profit is before selling or before recording operating expenses. Okay, so merchants make their money by marking up their goods and selling them at a profit over cost, because that profit has to pay for operating expenses. So merchandise not sold that's left over is just simply called inventory, which is an asset on the balance sheet for a merchant. So the nature of merchandising, at the top here we start out with cash, and when we first start our business, of course, that cash can come from personal investment of the owners, outside investment, bank loans, or any combination. We use that cash to buy the things we need to start our store, including inventory. We then sell that inventory through sales activities to our customers, who we either sell to them on account and we collect in the future, or we sell for cash and receive the cash immediately. And of course, as we collect more cash, we then use that to pay our bills, buy more inventory, and so on. And so the accounting for merchandising, we have to keep in mind that we have to do some accounting to buy it and then sell it. Okay, so it says merchandise inventory at the end of the period is determined by taking a physical count of inventory on hand using a periodic inventory system. Okay, so periodic means I only know what I have on hand by doing a physical count. Otherwise, I don't know what I have on hand for inventory. Okay, the other method is called perpetual. And perpetual means I always know what I have on hand because I'm perpetually updating my inventory record. So I always know what I have on hand. I'm keeping account of what I own. So every time I buy something, I add it to my account. Every time I sell something to a customer, I deduct it from my account. So as we buy inventory, we make a very simple entry that we see here. Okay, and it says that we debit merchandise inventory, credit cash, and that's for buying inventory by paying cash right away. And we're doing this for our Net Solutions company, which is kind of our sample company we've been looking at in previous chapters. Okay, and it says here, note we will assume the perpetual inventory method is used. So unless we're told otherwise, assume perpetual is the method that we'll use. So another example of an inventory purchase is to debit inventory and credit account payable for inventory that we've taken possession of today, but we'll pay for in the future. So we bought it on account. Somebody delivered it to us with an invoice saying you owe us X dollars, $9,250 on some date in the future. So an example of an invoice, so if we were Net Solutions, we call up Alpha Technologies and say we'd like to place an order, or we do this online, or however we place the order, and you can see that we then receive the goods along with this invoice. So then the goods will show up, and this looks like it was shipped to us through US Express Trucking, and it was shipped on the 5th. Invoice date was the 5th. So basically what that means is that if we as Net Solutions pay this bill within 10 days, we can take 2% off the bill. Otherwise, the net amount of the invoice is due within 30 days. So the invoice includes who we bought the goods from, the date, the the terms of repayment, the quantity of goods bought and the exact good bought, the cost per unit, and the total cost. So basically, as Net Solutions, we owe Alpha Technologies $3,000. Okay, and basically what they're saying is if we pay them within 10 days of the invoice date, basically by the 15th, we can take 2% off the bill, or the net amount is due within 30 days. So what they mean by credit terms then is to encourage the buyer to pay for goods before the end of the credit period, will offer a discount. So basically what Alpha Technologies is saying, going back to the invoice, is they'd rather get 98% of that $3,000 within 10 days rather than wait for closer to 30 days to get the $3,000 that's due. Okay, so they're okay getting 98% of $3,000 now, as opposed to 100% of it 30 days from now. And so this calendar here kind of shows you that just a little bit. We have the invoice date was January 5th. The discount period then is that 10 days, the 5th through the 15th. And so if the bill is paid by the 15th, then we can pay $2,940, which is basically 98% of $3,000, and get full credit for the invoice. Okay, if we wait, then we can obviously wait until February 4th, 30 days out, before we have to actually pay the $3,000. So what Alpha Technology is basically saying is we're okay taking 98% of that and getting paid sooner rather than 100% of that later on. So the next concept is purchase discounts, and a buyer may receive a discount from the seller or a sales discount for early payment of the amount owed. From the buyer's perspective, such discounts are called simply a purchase discount. Okay, so going back to, it says that Alpha Technologies, here's their $3,000 invoice. Okay, so it says they issued that invoice to Net Solutions for $3,000. It's dated January 5th. The terms are 210 net 30, and Net Solutions is trying to determine if it should pay the invoice within the discount period. Okay, so now Net Solutions has the invoice, and you can see what they've done is they have said, okay, we debit inventory and we credit account payable Alpha Technologies. Okay. And it says here Net Solutions can borrow cash at a rate of 6% should the firm borrow cash to pay for the invoice within the discount period. And the answer in this example is actually yes. It says the discount is $60. 2% of $3,000 is $60. It says interest for 20 days at the rate of 6% on $2,940 is $980. Okay. So they can actually save $50.20 by borrowing the money now and paying off the bill sooner rather than later. Okay, so maybe they don't have the extra $3,000 available right now, but if they borrow it, they have it, and then they can afford to pay the bill sooner, save $60 by taking advantage of the discount, but only have to pay $9.80 to save the $60. So obviously it makes sense to borrow the money, pay the invoice early, and save $50. And so let's just go ahead and assume that they do that and that they write a check within the discount period and pay the bill, and they would credit cash for $2,940, debit account payable for the full amount due of $3,000. And notice that we credit the inventory account because we have now reduced the cost of our inventory by $60 by taking advantage of the discount. It says then, let's just say assume that instead of paying the invoice within the discount period, they wait and they pay it towards the end of when it's due, and they pay the full amount due. So here we're basically losing that $60 savings, but we debit account payable, credit cash for the full $3,000. Purchase returns and allowances. A purchase return is basically returning merchandise that's either damaged or doesn't meet specifications, maybe wrong color, wrong size, poor quality, whatever the reason is. From the buyer's perspective, such returns are called a purchase return and allowance. So what if Net Solutions returned some of those goods bought from Alpha Technology? They'd call it a purchase return and allowance. When that happens, a debit memo is issued. It informs the seller of the amount the buyer proposes to debit to the account payable due to the seller. So just keep in mind what the term debit memo means. And so if Net Solutions is going to do a return, now this is a return to a different company called Maxim Systems, and it says we debited your account as follows, 10 server network interface cards are being returned to you. Our specified number is 825X. So we're basically saying that what we bought from you was of poor quality, the wrong thing, whatever it was, we're returning it to you and issuing you a debit memo, which then means that Net Solutions can record a journal entry which basically undoes the purchase. Okay, we're undoing the purchase. And so we debit the liability and we credit inventory because we're shipping the inventory back. It's not ours anymore, so we're shipping it back to who we bought it from. So it's just like undoing the purchase. And the debit memo is my source document to show, here's what happened. Okay. Merchandise purchase. It says now on May 2nd, Net Solutions buys $5,000 worth of inventory on account from another company, Delta Data Link. The terms again are 210 net 30. And also keep in mind that 2/10, n/30, we say that as 210 net 30. And that could be almost any combination you can think of. It could be 315 net 45 or almost anything. It's really what two companies agree on in negotiations, or sometimes it's just simply industry practice that determines what that number is. So we do go ahead and return the merchandise. It says on May 4th we're going to return 3,000 of that. So remember the original purchase was 5,000 and that was on May 2nd. And on a couple days later we're going to return some of it for $3,000. Okay, return a portion of it purchased, and again it's undoing the purchase. It's the opposite entry that we had on May 2nd. Okay, so we're instead of debiting inventory, crediting payable, we now debit payable, credit inventory. And then it says on May 12th, let's go ahead and pay the invoice off less the return and discount, right? So it was originally $5,000 purchased back on May 2nd. On May 4th, we returned $3,000. And then on the 12th, so basically within the discount period on the 10th day, we're going to go ahead and pay off the rest of the bill minus the discount. Okay. Let's see. Okay, so now that's basically how you record buying merchandise and potentially returning some of it. Now let's go ahead and sell that merchandise to our customers. So now Net Solutions has merchandise, is going to sell it to its customers. Okay, and it's going to do this for cash. So a pretty simple entry. We debit cash, we credit sales, both for $1,800. It says using the perpetual inventory system, the cost of merchandise sold and the decrease in merchandise inventory is also recorded. Okay, so when you have a service company, you just have this first entry. We just have a sale. But when I have a merchandiser, I also have to record the inventory sold through cost of goods sold. Okay, and so I debit cost of goods sold or cost of merchandise sold, and I credit inventory for the inventory that was mine that I now sold to a customer, so it has to go away. Cash sales, it says sales made to customers using credit cards are recorded as cash sales, assuming Net Solutions paid credit card processing fees of $4,150 on March 31st. So if we have to then pay those credit card processing fees, that's just simply an expense. We debit the expense and credit cash to record the service charges that the credit card companies have charged us. What if we sell something on account? Selling something on account, very similar to selling it for cash, is instead of debiting cash, we debit account receivable. We still credit sales, and we still have the cost of goods sold portion of the entry done. So we debit cost of merchandise sold, credit inventory, both for $10,800. So basically, revenue of $18,000, cost of goods sold of $10,800. So now what happens then when we're the merchant and we're selling goods to our customers and we're selling on account and we're offering credit terms that are favorable and basically saying to our credit customers, if you pay us within 10 days or whatever that term is, you can take a discount when you pay us. So what happens then, we had that sale of $18,000. So it's going back to a couple screens here. And basically in March, whoops, went too far. On March 10th, we sold on account $18,000 worth of goods to Digital Technologies on March 10th. Okay, they go ahead and pay us 9 days later. And what if we offered a discount of 2%? Okay, so they're going to pay us within the discount period, and we'll receive a check not for $18,000 but for $17,640 because of the $360 discount that was taken that we allowed for. And so we credit account receivable for the full amount owed to us, $18,000. We debit cash for $17,640, and we debit an account called sales discounts of $360, and that's going to hold all the discounts that we've granted within this accounting period. So then what happens if one of our customers goes ahead and returns goods to us? We'd receive a credit memo, okay, authorizing a credit or decrease to a buyer's account receivable. You can see what a credit memo might look like. We could issue a credit memo to a career company. We credit your account as follows: 10 graphic video cards for $2,250 if that was a return or something like that. Okay. And so it says as we issue a credit memo, the merchandise is going to be returned to Net Solutions. And so it's quite possible they called this up and said you sent us the wrong thing, or the product is of poor quality, we're going to ship it back. And so we issue the credit memo to show that we agree, that's fine. And then we get the merchandise back, and we go ahead and make the entry to basically undo the original sale. Only we don't debit sales revenue, instead we debit an account called sales returns and allowances, and then we credit account receivable. And then we also bring the inventory back, we own it again, we debit the asset inventory, we credit cost of goods sold. Okay, so basically we undo the sale. Now the thing is, we don't debit sales, we debit sales returns and allowances, which is kind of like a contra revenue account, just like sales discounts. It's a revenue account with a debit balance, and so net revenue is basically your sales account minus the contra revenue accounts. Then I get down to freight. It says if ownership of the merchandise passes to the buyer, when seller delivers merchandise to the freight carrier, the terms are said to be FOB, which stands for free on board shipping point. So basically, who's paying for the freight determines when legal title of the goods passes. Okay, so if it passes to the buyer when seller delivers to the freight carrier, basically what it means is that's the buyer is paying for the freight, and they take possession when goods are delivered to the freight carrier, a truck typically. Okay. It says on June 10th, Net Solutions bought merchandise from Magna Data on account, $900, FOB shipping point, and pays a shipping cost of $50. So what that means is if we're the buyer and we're paying the freight, that's a cost of buying inventory, and we debit the inventory account for that amount. So we debit inventory, credit cash for the 50, but we bought the merchandise on account, so we debit inventory, credit account payable for 900. Typically what happens is if a truck shows up with our goods, we pay the truck immediately, but then with the invoice we pay the merchant we bought the goods from whenever the due date is. Okay, it says that if ownership passes to the buyer when the buyer receives the merchandise, then it's called FOB destination, and typically it's the seller that's paying the freight. So if the seller is paying the freight, so here it says sale plus freight cost. On June 15th, Net Solutions sold merchandise to Kranz Company on account for $700. The terms were FOB destination, okay, and it says cost of the goods sold is $480. So we'll go ahead and we will record the normal entries that whenever we make a sale. So we'll debit account receivable because it was a sale on account, credit sales, debit inventory, or I'm sorry, debit cost of goods sold, credit inventory, and then we have to pay the freight. So the next slide then is to say we spent $40 to pay for shipping, and so we'll debit expense, credit cash to pay for that. So shipping point versus destination, just know who pays based on shipping point or destination. That will help you as you do the work in Cengage now. So seller pays the freight. It says Net Solutions on June 20. They sold merchandise again to a different company, Planter Company, on account $800, FOB shipping point. Net Solutions paid the freight of $45, which is added to the invoice. The cost of merchandise sold was $360. Okay, so here's what they did then. Now it becomes 3 entries because you record the sale. That's the first entry. You record the cost of goods sold portion, which is the second entry. And the third entry is we prepaid shipping cost on this one. So we debit account receivable and credit cash because we prepaid the shipping. So just some pictures to be able to visualize it. When you see FOB shipping point, title passes to the buyer when the goods are delivered on the truck. Basically, once the goods are in the truck, buyer has title, okay, and the buyer is paying the freight. Okay, the seller has no journal entry. Only the buyer does to pay for the freight. And remember, the freight cost is a debit inventory to credit to cash. Under FOB destination, now the seller's paying the freight. It's an expense for the seller, and then we credit cash, and the buyer does not make a journal entry regarding freight. Okay, so just make sure you know the differences between those two. Okay, so just to keep in mind then, just to kind of summarize these entries, you can see for the merchandise inventory account, the various debits and credits that we can record as we make these entries, and same thing for cost of merchandise sold. You know, the black entries are kind of one grouping, the blue entries are another grouping, and the green entries are another grouping. Okay, so just be aware of basically the 3 types of entries that impact the merchandise inventory account and the cost of merchandise sold account. In this example, they're talking about the dual nature of merchandise transactions. They're basically showing both sides, the buyer side and the seller side. And so it says on July 1, Scully Company sells merchandise on account to Burton for $7,500. Terms are FOB shipping point, net 45. Okay, basically the total amount due is due within 45 days. Cost of merchandise sold is $4,500. For the seller then, remember the seller has two entries. Record the sales portion of the entry, then record the cost of merchandise sold part of the entry. For the buyer, it's just debit inventory, credit accounts payable. Okay, but just notice kind of how they offset. Then it says that Burton Company paid for the freight on July 1, purchase from Scully. And so Scully, the seller, didn't pay the freight, so there's no entry. Burton, the buyer, did pay for the freight, so that's just a cost of buying inventory. So we debit inventory and credit cash for the $150. And then on July 5th, Scully sold merchandise on account to Burton. $5,000 FOB destination, net amount due within 30 days. Cost of merchandise sold $3,500. So Scully makes the typical two entries when you sell a good to a customer, and Burton makes the typical entry when you buy something from a vendor. And then on the freight part of it, because this was because Scully Company is paying for the freight, that's simply delivery expense. Okay, they debit expense, credit cash. And then on the 13th, Scully Company issues Burton a credit memo for merchandise returned that had been purchased by Burton back on the 5th. The cost of goods returned was $700. Okay, so basically some of the goods that Burton received were either of poor quality or the wrong thing, whatever it was. Burton contacted Scully and said, I'm going to send something back. I'm going to send $1,000 worth back. Scully, of course, would then issue a credit memo, and then when they get the goods back, they're basically going to undo the sale. Okay, so they debit sales returns, they credit receivable, they debit inventory because Burton owns Scully owns the goods again, and they credit cost of merchandise sold. And for Burton, they're just undoing the purchase. $1,000 worth of the purchase, they just simply undo it. On the 15th then, Scully Company receives payment from Burton from the July 5th purchase. And so remember, the original purchase was $5,000. $1,000 was returned. So now it's just a matter of Burton writing a check for $4,000 and paying Scully back, and paying Scully. So notice that Burton credits cash, debits accounts payable, and Scully debits cash, credits account receivable. So you kind of see how the two entries relate to each other for both of the companies. On the 18th, it says Scully Company sold merchandise on account to Burton. This time it's $12,000 FOB shipping point. The credit terms are 210 net EOM, which stands for end of month. So basically the net amount is due by the end of the month, or if payments received within 10 days, 2% can be taken off the bill. Scully prepaid the freight charge, which was added to the invoice. The cost of goods sold was $7,200. Okay, so Scully then goes ahead and debits receivable for the inventory cost of $12,000 plus the freight of $500. You can see that credit sales for $12,000, credit cash for $500. They record the cost of goods sold as $7,200. For Burton, notice that because the freight was prepaid, they're adding that to the cost of inventory. So they're debiting inventory for $12,000 plus $500, and the credit accounts payable for $12,500. Also then, Scully Company received payment from Burton Company for purchase of July 18th less a discount of $12,000. So notice that the discount for Burton then they go ahead and on the right hand side, look at Burton. They save 12%. Okay, and so 12%. I'm sorry, 12%, 2%. Let me say that right. 2% of 12,000 is 240. Okay, and so notice that they're applying that 2% not to the delivery, but to the inventory cost itself. That's a key thing to remember, is that discounts don't apply to cost of delivery. They only apply to the cost of the inventory itself. So 2% of 12,000 is 240, and so a debit account payable for 12.5, credit inventory for 240, credit cash for 12,260. Okay. For Scully, then, of course, they receive cash at 12,260. They debit discounts for 240, and they credit receivable. Okay, so they're receiving payment for inventory plus the delivery fee. Okay. Now we've looked at a chart of accounts previously, but just wanted you to be aware that what you see that's kind of a pinkish purplish color there is accounts that are new and unique to merchandisers that service companies don't have. Okay, so notice that we have for assets the addition of inventory. It's really over on the revenue side that there's a lot of changes. Now we have, instead of fees, we have sales, and then we have the contra revenue accounts, or the contra sales accounts, sales returns and allowances and sales discounts. Under expenses, we now have cost of merchandise sold and delivery expense that service companies don't have to worry about. Also keep in mind that businesses quite often also collect sales tax. And so it says here, August 12th, merchandise is sold on account to Lemon Company for $100. The state has a 6% sales tax. And so you are recording the sale plus you're collecting sales tax. So you debit account receivable for 106. You credit sales for 100, but then you have to record a payable of $6 because that $6 has to be remitted back to the state. And so on a regular basis, and it really just depends, like in South Dakota, it depends how many sales you have. You might do it weekly, monthly, quarterly. This depends on how big you are. But then on a regular basis, you have to remit the sales tax you collected back to the state. And so you debit sales tax payable to say, I'm paying this liability, and I credit cash for all taxes collected in a particular month. A trade discount is when a wholesaler offers special discounts to certain classes of buyers who order large quantities. That's just simply called a trade discount, which maybe only certain buyers can take advantage of due to volume or things like that. Okay, let's talk about the financial statements for a merchandiser. We'll talk about how they're a little bit different than a service company. A multi-step income statement contains several sections, subsections, and totals. We'll look at what those look at here real soon. And you can see for a merchandiser that a portion of the multi-step income statement, you can see this is for Net Solutions, our sample company we've been looking at. And we've got their sales number, 720,185. We have to subtract from that the contra sales, the sales returns and allowance account, and the sales discounts account to get down to net sales. So it's always sales minus the contra sales to get down to net revenues. Okay, so sales is the gross amount charged to customers, okay, which is both cash sales and sales on account. Sales returns and allowances are the returns or allowances simply granted by the seller to customers for damaged or defective goods. And sales discounts is any amount granted by the seller to customers for early payment of amounts owed. Okay, and then net sales is just simply the difference between those amounts, and that's the net sales numbers is the last line of the revenue section of the income statement. And of course, cost of merchandise sold represents the cost of merchandise sold to customers. It's what the merchant's cost was to acquire the inventory before it was sold ultimately to the customer. And it also includes costs getting it ready for sale, such as purchase costs and freight costs. And so here's an example then of a multi-step income statement. And you can see here that we have total revenues, net revenues of 708,225, and then we subtract from that cost of goods sold, which is 525,305, to get down to gross profit. And then from gross profit we subtract out expenses. And you can see we classify expenses between a couple of different categories here that we'll talk about in just a moment. Okay, so you can see the gross profit number is a pretty important number in a multi-step income statement. So once I have my gross profit, I subtract from that my expenses, and my expenses are organized in a couple of classifications. Selling expenses first, and those deal with expenses I incur directly to sell my merchandise. So sales, store supplies, depreciation of my store, equipment, delivery expenses, advertising expense. And then I have everything else, which is administrative, or sometimes it's called general expenses, which is basically everything else. More typically administrative type, which is office salaries, depreciation of office equipment, and office supplies used. Think of executive costs also would be here. So there are my two categories right there then of expenses, my operating and my which is split into selling and administrative. And then the income from operations is a key number also. It's sometimes called operating income, and that's basically the my bottom line that I control. So basically, based on the decisions that management has made to sell goods at certain prices, carry certain products, mark them up at a certain amount, deduct a certain amount of expenses, record for expenses that we incur, we get down to income from operations. Okay, it's basically operations that we control, that we earned by being a merchant. Then we have our other expenses and other revenues, just things that are kind of more ancillary to our business. It's not something we're involved in on a day-to-day basis. You can see we had an example here of rent and interest. So those are very common types of revenues and expenses to incur. We also have what they call a single-step income statement, which is basically the same information as a multi-step, but fewer subtotals. And not as popular because we don't necessarily get to see gross profit. And you can see we just kind of combine my categories into a much more simplified format. So it's not as popular because we don't see quite the same amount of detail. The statement of retained earnings for a merchant is exactly the same as it is for a service company. Remember that the goal of this financial statement is to track what my beginning retained earnings was to my ending number. It goes up for net income and it goes down for dividends. Next is my balance sheet. Remember that shows me my assets, liabilities, and equity, making sure that everything balances. And when I have when I have liabilities and equity on the right hand side, we call that the account form. Let me just show you just kind of what they look like here. So here's the report form of the balance sheet, where I have assets at the top, and I just go down horizontally to get down to liabilities and equity. That's the report form. If it was assets left and liabilities equity on the right, that'd be the account form. Okay, merchants, just like service companies, have to do both adjusting and closing entries. And it says that merchants, of course, can experience some loss of inventory due to a number of things: shoplifting, employee theft, errors in recording inventory, sometimes damage. And when that happens, we have to make an adjusting entry. And at least once per year, and no matter what kind of inventory system you use, at least once per year you have to do a physical count. And you compare your physical count to your records, and they're going to be different. It's just the nature of merchandising is they will not be the same number. And we then make a journal entry to adjust the physical count to our records. And typically the count is lower than our records because inventory sneaks out the door. Okay, and so you can see in this example, we call that shrinkage. For this company, they experienced $1,800 worth of goods that snuck out the door, and that's called shrinkage. So we're going to make a journal entry to record that, and you can see that my balance is $63,950, my count $62,150, the shrinkage is $1,800, and so I'll make an entry then to debit cost of goods sold, credit inventory, so basically increase expense, decrease assets for the amount of that shrinkage. And now my accounting records and my physical count are exactly the same. So merchants make all the same adjusting entries that service companies do, but they have the addition of the inventory shrinkage adjusting entry. For closing entries, merchants have the same 4 closing entries that service companies have. It's just that they have a few more accounts to close, right? We have sales instead of fees earned, and then we have a few more types of expenses. We have the contra sales accounts, plus the merchandise sold expense, and so on. We just have a few more types of expenses to close and worry about. And so the same steps occur. Step 3 is we close income summary, and step 4 is we close the dividends account. Okay, and of course we need to post those and make sure we close out income summary to have a 0 balance. Okay, the final thing we'll look at is just some ratios. We typically look at a few ratios at the end of a few chapters, and one ratio that we have is net sales to assets. Basically, how efficient are we at using the assets of the business to earn revenues, to earn sales? And we can just crunch those numbers, and we can see that we can look at our revenue numbers here for year 1 versus year 2. Typically, when we look at an average, we're combining 2 numbers and dividing by 2. And you can see here, that's what we did, is we came up with in year 2, for every dollar of asset, we had $2.52 of revenues in year 2. In year 1, it was $2.42 of sales for every dollar of asset. And so the number got better. The higher that number is, the better off you are. So that's just a ratio to be thinking about in terms of merchandising. Okay, I'm not going to cover the appendix, but just wanted to make sure that you are aware of the merchandising concepts. As always, make sure you read your chapter. Go to the accountingcoach.com website, look at some of the information there regarding merchandising also.